Good afternoon and welcome to our first BörsenTalk on Mittag in 2023. My name is Andre Buch, member of the Executive Board of SIX Swiss Exchange, Global Head Sales and Relationship Management. It's my great pleasure to welcome the Swiss and international investor community to this webinar. Make yourself comfortable wherever you are, home office, or even traveling. Today's focus is on equities, the closing auction and its liquidity. The trading of shares worldwide has changed dramatically over the last couple of years, and it's not comparable to the pit trading of the past. One could reflect with nostalgia to these past times, and finance museums remind us how it all began. Regulation, technology, and changing customer behavior are constantly bringing innovation to the table, challenges that trading venues and their participants must actively address. With that in mind, I welcome you once again to today's BörsenTalk on Mittag webinar. Before we start, I would like to inform you about some housekeeping. And if you have been part of our previous webinars, then you know already that we use Slido to capture your questions. So please take your smartphone and go to slido.com and put in BörsenTalk 23. And I will start that and show you that it's easier for you. So you can take a picture of the QR code, which takes you automatically to the correct web page. Put in BörsenTalk 23. I've prepared a poll just to see that we're all on the same page. So it's about the closing auction in Europe. European equity trading venues captured last year about 23% of on-book trading volume. How much will it be this year? So please press the answers about the same, more or less. And then we see also straight away that you are online. I will answer the question as well. Okay. Yeah, answers are coming in. So the verdict seems to be pretty clear that the audience expects certainly more trading will be done in the auctions. Very good. So if you have any questions during the course of the webinar, please also use the Q&A area and type in your questions. The panel will answer some of these questions towards the end of the webinar. This webinar will also be recorded and made available to you in the next few days to watch parts of it or all again for your own convenience. So now enough of talking. Let's get started with the webinar. Last orders, sourcing liquidity at the close. Please, Adam, the stage is yours.
Thank you very much. Hello, everyone. My name is Adam Sherlock. I am the head of equity sales for Europe at SIX Swiss Exchange. It's my privilege to moderate this panel today titled, as Andre mentioned, Last Orders, Sourcing Liquidity at the Close. With my panelists, who I shall let introduce themselves shortly, we'll be discussing all things closing auctions, including trends and the shifting dynamics of European closing auctions, managing market impact in the close, sourcing additional liquidity and overperformance, and comparing the impact of different close mechanisms run by different primary markets. I will also not so subtly be plugging our upcoming auction volume discovery order type later on, which is highly topical to our conversation about sourcing additional liquidity around the close. And now I think it's time for our panelists to introduce themselves. So if maybe we could start with you, Thomas, to kick us off, please. I think we have a small technical problem on the presenters being able to share themselves. Tomau, I think we can hear you now, but we can't see you.
Yep.
There we go.
Of course, just at the right time. Thank you. Thomas Bourgeois, Head of Execution Product Strategy at BNP Paribas Exane. Thank you, Adam.
Thank you very much. Gordon, if we could go with you next, please.
Thanks, Adam. Gordon Wood, EMEA Equity Trading at Invesco.
Perfect. And then last but not least, Drew, could you introduce yourself?
Hello, everyone. I'm Drew Vincent, and I run the AES sales trading function at Credit Suisse.
Perfect. So let's jump into our first question. Topic of the question will be around the value traded and changing dynamics of the close. The growth in the proportion of value traded at the close has been a hot topic in European equities over the last few years. In the Swiss market, looking domestically for us, the closing auction volume grew year on year from 2016 to 2021, but bucked the trend for the first time in 2022, reducing from 26% of on-book trading down to 25%. A theme not perfectly replicated, but broadly similar to a lot of other European markets. Looking a little bit more granularly within the close as well, we've seen some behavioral changes within the call phases. We've seen a lot more price volatility of the indicative closing price during the call phase, up more than 4 times as much volatility in 2020 to 2022 versus 2015 to 2017. And finally, big changes to the way in which the imbalance has persisted during the call phase at the end when we come to the uncross, reducing on our market at least from around 10% back in 2015 to record lows of around 3.5% in 2022. So maybe kicking things off with you, Drew. A lot has been written and said about the growth of the closing auction. But for the first time last year, we saw, at least in our market, and I think in a lot of other markets, a bit of a reduction in the amount traded in the close. What do you think is the major cause of this? Is the first part of the question. And the second part of the question is some of those other changes we described around, price volatility and imbalance and evolving call phase behaviors. How have you guys reacted to those changes with regard to how you execute at the close?
Absolutely. So there's a lot going on here. I think one of the first important things to look at in terms of impact on the proportion of the day's volume that goes through in the close is volatility. If you look at the data, you can see that there's a pretty clear inverse relationship between how much volatility is going through the market and how much ends up getting traded in the close. And that's kind of intuitive. If you have major news that's coming out either overnight or intraday, I think quite a few of us on this call will remember the day that Pfizer announced the vaccine. There's a lot of trading that has to happen very, very quickly and can't wait until the end of the trading day. So I think when you see more volatility, as we did certainly at the start of 2022, big jump in volatility there with some of the geopolitical events, naturally you're going to see some trading shift out of the closing period into intraday trading. You could also make an argument about, what is the natural level for the amount that's executed in the closing auction, because it is, it's a long trading day that we have in Europe. And so I think, there can really only be so much not happening throughout the rest of the trading day. And then just one other thing to look at, and this is to a degree born of the volatility, but if we look at the index events, which have a bit of a disproportionate impact on how much gets done in the close in aggregate, we saw some really big years for index events, 2020, 2021, saw some pretty material volumes going through, and that's come off a bit. And that may also have some impact on how much proportionally is going through in the close. So a lot going on there. I would say volatility is probably the main driver. And that for us is driven home, looking at our data, what we can see is actually into the end of 22, we see a bit of an uptick in what was going through in the close. A number of things that could potentially impact that. But we think, volatility coming off could certainly be involved there. And as to the second part of the question, yes, we've definitely noticed some behavioral changes, particularly based on the type of auction. And I think we're going to get into that a little bit later. But significantly sharper price moves right at the end of the auction, which has made getting our controls right very important. We've changed some of the strategies in terms of how they participate in the close, but then also closing estimate models are very, very important now, and how you assess whether you're right and the volume just hasn't come in yet, or whether you really need to adjust what you have allocated. And again, this is particularly important when we hit index rebalances. So quite a lot going on, quite a lot to adjust and build.
Oh, thank you. Very, very insightful as well. Thank you for that, Drew. Gordon, do you share some of Drew's, hypothesis around, let's say, volatility being one of the main drivers for the reduction we saw in the amount done in the close last year, albeit a small reduction?
Yeah, definitely. I think firstly, as Drew said, we have sort of reached that natural sort of maximum participation, or sorry, maximum sort of volume on the close. 20, whether it's 24, 25, 26%, it's all sort of there or thereabouts, isn't it? I think just that little bit of a pause for breath over the last few years, with just the continued growth, going from 15, 20, 25, it's kind of reached that point, particularly over the last few years when you've seen a sort of flow from active managers into passive. That sort of exacerbated it. But now that there seems to be a little bit of a leveling off, and certainly from our point of view, we'd love more money to come back out of passive and into active. Give us more to do. As Drew said again, we do have a very long trading day. So if you can, if you've got 1 million shares to buy over the day, you're not sort of looking at, oh well, let's just do half now, or sort of half over 8 hours and then the other half in 5 minutes. I mean, or rather at sort of 1 second. It seems kind of crazy. And are we sort of doing ourselves out of a job if we're just going to all become sort of slaves to the close, if you like? So that's one thing. The other thing I sort of noted was, if a lot of us on the active management side are sort of measured, if you're measured on say a PWP 5 or 10 or 15 or something, you're sort of measured on that point throughout the day, and you think, okay, I'm doing pretty well, I'm sort of picking my spots, I'm working a little bit passively, I'm picking my spots, I'm looking for some natural, I'm looking for some good liquidity, but then completely blow the number out by a huge close, then you can either look very, very good or very, very bad. Because if you've done the majority of your business throughout the day, and you've been buying throughout the day, and then it's a really low number on the close, you go, oh great, it just closed really well, so I've managed to buy the rest of my liquidity. But then you go, oh, but actually I probably should have traded several million in the close just to try and sort of keep up with that sort of PWP number. So yeah, I think we're kind of there or thereabouts now, is the sort of general answer to the question.
Interesting. And do you see changes in the way in which your brokers, or perhaps you directly, are interacting with the close over the last 4 or 5 years, with regard to the fact that perhaps the call phase has become more under scrutiny? We see more volatility, and that it changes in the imbalance more frequently than we used to see, that kind of thing.
No, I don't think so. I think yes. Obviously, algos have been sort of weighted a little bit more to the close, and still, if you're using a high touch broker, you still sort of have to specify including auction or excluding auction. It almost shouldn't need to be a question anymore, unless you're doing something yourself in the close. It should just be, if I'm giving you an over the day order, or you're matching up liquidity against a contra, it shouldn't be a question. It should just be sort of assumed that you want to be in the close. That may be different for other people, but I would certainly say that.
Oh, thank you, Gordon. Great insight. Thomas, do you generally agree with your other panelists on the way they've discussed this particular question, or couple of questions?
Yes, Adam. Thank you for the opportunity. Yeah, the percentage of the close, we agree. I mean, higher in the UK than it is on the rest of Europe. On the drivers of, we see that, just for reference, we see it as a 19% in Europe and 24% in the UK recently. But we include primarily MTF fleet, MTF dark, and auction volumes when we compute these numbers. As to the cause of the growth in close now, which has indeed plateaued. Agreed. It seems to be a self-sustained mechanic at play between the growth in passive assets under management, resulting into more close VWAP volume curves and quant funds using VWAP, driving that number higher, which in turn gives derivatives hedging the opportunity to trade an increased portion of the gamma into the closing auction. So you've got a mechanics here which is driving the auction price, the auction percentage of higher. In terms of share.
Unless it's just me, we've lost Thomas momentarily. Let's just give it 5 seconds, see if it comes back. Perhaps not. Right. Let's jump into the next question. Hopefully we can get Thomas back in a second. And if we do, we can come back to the second part of his answer for the first question. Market impact. With the growing significance of the close and the consideration given to the market impact of closing auction orders probably naturally rises too. We understand that traditionally the buy side have often deployed participation caps or participation rates to their closing liquidity to limit their perceived impact on the close. How do you navigate at close impact for your orders or for your clients' orders? And maybe Gordon, if we could kick things off with you on this question, please.
Yeah, sure. Certainly we use volume limits, but not so much price limits. I think it's really important to this is me personally talking. We sort of discussed it across the desk, and we all do things slightly differently. But certainly for me, I like to go in as a market order, even if we've gone just a sort of small percentage, you know, maybe a sort of a 4 or 5% POV, and then you can start adding a little bit to that. But I don't particularly like putting price limits on, because I just think that you can be too influential on the sort of price formation. So yeah, I would personally sort of towards sort of going at market. And if you do want to put a little bit more in, maybe you could use a limit. But I think it's best if you're just putting a little bit in at the start, a little bit throughout, then and you see that the volume is building and it is to your advantage, then you can just put some more volume in. I just sort of, unless you've actually got an explicit limit from the fund manager, or you're sort of working to achieve something slightly different, then day to day, obviously trade by trade is important, and no trade is the same. But I would tend to sort of towards going at market. We also, being an active manager, we don't, if we're trading a sort of 5, 6, 7 day trade, we don't have to trade every day. We don't have to participate during the day. We don't have to participate in the close. We're trying to be opportunistic about things. So if that price in the auction is not favorable, or if there's not significant volume, we'll just sit out.
So in other words, unless for a lot of your orders, you're kind of almost managing the impact by eye to some degree. Is that fair to say? In terms of really watching the call phase itself, trying to react to the liquidity and the volume you see, and the price that you see as well, in terms of, if it's a multi-day order, not wanting to necessarily oblige yourself to be a big portion of the auction if the price doesn't look great for you right now.
Correct. On my blotter at any one time, we've probably got 2 or 3 sort of orders that are multi-day orders and need quite a lot of care. So if you can sort of be quite hot on those, you can sort of automate or not worry too much about 90% of your flow that you've actually got, but it's just those 2 or 3 orders that you might just go, right, I'm going to be all over this in the close. I'm going to be able to sort of pick my spots, and I'm going to sort of put little bits of extra volume in here and there. So yeah, it is trade by trade, but yeah, as a sort of an active trader, you need to be able to be quite hot on it in that sort of 5-minute period.
Oh, thank you.
And there's also actually, if I can just one little note I did sort of write down here as well, was there's been quite a lot of debate about at the very, very beginning of the auction, as in 4:30 or 4:25 plus 1 second, are you going to put all of your order in? I know that different exchanges have worked done sort of different projects on this and sort of run different numbers, but do you think it's the best to sort of put all the volume in at the start of what you're trying to achieve, or would you sort of drip feed in? I guess that's an answer. That's a question, not just for you, Adam, Drew, but and Thomas as well.
Oh, it's a really good question. We definitely, as the exchange, are not the experts in that area. I guess we're more the recipient of liquidity than the prescriber of where it should go. But we definitely see brokers probably falling into one of 2 camps, one of which is potentially sort of overshowing liquidity up front and trying to coax out contra liquidity, and the other being, I'm more of a true kind of reflector or respecter of adjusting real time to the volumes as they evolve and really hitting my numbers that I want to hit, percentages or otherwise. So I'm sure there's a hybrid between the two, but we definitely see kind of both at play, and it's communicated to us by some of our clients. And maybe a good time to transition to Drew and say, market impact generally. What's the Credit Suisse take on it? And maybe you have an immediate answer as well to Gordon's question around that.
Sure. So we have to reflect our clients' preferences. And what I would say then is that we don't really solve that problem one way only. We have some clients who, as you say, I'm not sure exactly the word you use, market respecters. We have some clients who really want to be right in there in line with volume and not tip their hand. Maybe clients who are working, large multi-day orders tend more to fall into this camp. Whereas those who can be a little bit more opportunistic, we also facilitate flows of get in there early, big, potentially be at market, and then try and adapt to what you see later on in the auction. So we have a variety of different behaviors. A couple of things I think have been mentioned more frequently by clients recently. There's been a lot of appetite for some sort of scaling close behavior. So to Gordon's point, this is the idea of you're not necessarily using a price limit to control your behavior as such. You might be at market, but responding to some of the things that you see in the auction to determine exactly how much volume you want to target. And I think we're going to come on to this again later. So that's a behavior that we've seen increasingly, where clients will give us kind of an acceptable range of participation to make sure they're not, sitting out the auction entirely. But over that range, giving some discretion as to how we decide what is and isn't a good opportunity. A few other things that we utilize in terms of controls. So we do have clients that will utilize limits in the close. Some of these are relative limits, and we've got quite a divergence in terms of benchmark that clients use when they're determining how to limit their orders into the close. So probably the most common benchmark is the last traded price. And that's, a very easy to understand metric. It's fairly simple. It's usually pretty decent in terms of controlling your impact and making sure that you don't participate in a very adverse move. But it can be a little volatile, especially if you have clients who are kind of racing to complete orders before the closing auction happens. You can get some fairly significant price dislocations in the closing seconds. So we have other clients who might be using something like a 5 or a 15-minute VWAP in order to determine their kind of last price benchmark when determining how they're going to limit their order into the close. We've seen more utilization of the TAL, so more interest from clients in utilizing TAL phases. There can be some technical difficulties in terms of getting client preferences around the TAL expressed well. There are some clients who only want to participate in the TAL under certain scenarios, but we have actually found that to be a very useful period in kind of some limited circumstances. And then harking back to one of Gordon's earlier points, another behavior that we've seen requested from clients is basically what we would call setting a wood level on the close. So a client who has a price level where they know they're absolutely happy to participate. They're not particularly concerned. They could be 60% of the auction uncross, but if they determine that that's a favorable price, they want to be involved. So quite a lot of differentiated behaviors. I think they depend very strongly on the client type. You see a big split here, I think, between passive clients and active clients in terms of the types of controls they're utilizing and what they're willing to tolerate. I think there's a big difference in clients who are comfortable with holding over some overnight risk versus those who are really trying to complete and only prevent the most kind of savage of outliers when determining when not to trade or when to reduce trading.
That's really interesting, Drew. Do you find there's been a change in the mix at all between the clients that perhaps moderate their impact in different ways, or is it broadly the same type of clients have managed that impact in the same way, or their perceived tolerance of price in the same way over the last 5 years? Maybe the amount traded by them has shifted, but really the methodology isn't really moved much.
I think where I would say I've seen the most shift is with active clients. I think there has definitely been a move towards being a little more opportunistic and maybe having a bit more tolerance in terms of overnight risk. I think there's been a recognition by the buy side that the close can be a significant liquidity event, and there are times when it's advisable to over participate versus say a strict percentage of volume model, and there are times when it really is okay to pull back and save some for the next day. I think some of that has come with increasing sophistication of impact models, active clients especially, but really across the client suite, getting involved in TCA and understanding kind of the trade-off between having a bit of impact in the close versus overnight risk and then the cost to trade the next day.
Oh, thank you. Really insightful. Thanks, Drew. Thomas, we have you back. Let's just check the audio. We can hear you?
I can hear you. Sorry.
Fantastic.
For that.
Good.
Unfortunate connection issue.
Problem. So we're on the topic of market impact. I think you probably guessed. The real question that Gordon and Drew have already had their first shot at is, how do you really navigate close on behalf of your client base? Navigate impact on behalf of your client base in and around the close?
Yes. So we provide trading tools and our clients use them. But when we looked at the data, which we did 4 years ago now, and presented quite extensively to our customer base, what we found the statistical relationship between imbalance in the auction and during the period before market makers come in and pile in and help the price formation at the end of the auction. If you look at the imbalance early on in the auction, there is a very, very nice, very clear linear relationship, which equates to roughly 10% of extra imbalance in the auction, yielding 5 to 10 basis point close impact as measured by closing price versus last traded price, continuous traded price. So with that relationship established and presented, we went on to build a solution, which has indeed spread a bit around the market now, but which control for participation based on indicative price, and all the way till the last second in the auction. So you will scale up your participation or scale down your participation based on the price the auction is publishing, and it allows customers to control better their own impact in the auction. Historically, the tools from the buy side from the sell side, tend to send orders quite early on in the auction, so therefore creating there is an imbalance which materializes quite early on, and it's only towards the end of the auction that this imbalance is dealt with. Now, with the algorithms and the strategies we've offered, and which are widely available, you can now decide whether you must complete, and therefore you are happy to tolerate a certain impact to complete, or you scale down, or you're completely opportunistic and you could go much higher in the closing auction than you would have otherwise have. So using it in a more discretionary way as an extra source of liquidity, because what we haven't said is that that relationship between imbalance and closing price, it's a good price. It's a good price compared to continuous trading usually. So yes, as Gordon mentioned, there can be a high cost in high volatility period to wait until the auction, and it's not ideal. But once you get there, there is no reason why you shouldn't use the auction as a good source of extra liquidity. So what we've that was a few years ago now, and we've kept evolving, refining the mechanics to deal with auctions with less information published maybe. And also what we've done more recently is to add that relationship. I said that relationship between impact and imbalance and impact is quite linear. However, the shape of the order book is everything but linear. So it's not like you've got I don't know 50 shares on every level and it's completely linear. So what we do now is to give the algorithm a bit of discretion to adapt its behavior to the very shape of the order book. So if there is a cost of 1 basis point extra for 1 share, maybe it's not worth getting that 1 share. You know, yes, everybody likes to complete, but really for that. So we've baked that in. So that's quite a good one. And also the auction has this particularity that everybody bears the cost of impact of a single behavior. So if a single participant trades that 1 share, everybody incurs the price. So there is as a community, it's really in our interest to adopt as many of these price controls rather than delegate the price formation to the market makers.
It's really insightful, Thomas. Thank you. And do you see generally your clients, the popularity of that scaling close, or however exactly you define that, the name of that product, do you see the popularity rising? Have you seen more and more clients adopt this? Short answer, yes. Good.
I think we were quite early on that. So, but as more and more people came to adopt it and the findings became more widespread, I think it facilitated the adoption. Yeah, everybody understood. So, and also it's available in every single algorithm. So while as Gordon, I think you mentioned earlier, we shouldn't have that conversation with someone that you need to specify that the close should be included. In the same way, there is no reason why you should use a specific ultra different algos to do that in the closing auction. You should have this ability to control your participation in the closing auction from every algo. So if you want your VWAP to trade more in the closing auction only insofar as it improves the average traded price over the day, that's doable. So all these features have been added bit by bit as customers came back with new ideas, and we took them on board.
Thank you. Really interesting. let's transition into question 3. But before I do so, please don't forget we have the Slido running. Everyone who's dialed in, feel free to throw some questions in there. Now we've begun to set the scene for the topic today. Andre, thank you for sharing. You scan that QR code and hopefully we get a minute or two at least to answer a couple later on. Question 3, and this is around sourcing of additional liquidity, and this is where my plug comes in, so apologies. In May this year, we'll be launching our auction volume discovery order type. We call it AVD for short. It's designed to help find matches for orders where some liquidity remains beyond the tolerance for participation or for price impact, more importantly. This order type will give the opportunity to trade non-display in both the opening, but in particularly important today, the closing auction, as part of the actual auction uncross, but without contributing to price formation and without any information leakage on your order being there. Aside from hopefully the markets and your adoption of this order type when we go live, how else do you guys consider the sourcing of additional liquidity outside of the traditional primary call phase of the auction to assist your performance on behalf of client orders or your own orders in the auction? And maybe, Thomas, you've been last twice. Let's kick off with you, please.
Yes, for bad reasons, but thank you. Well, listen, as Brian Gallagher says, the European close is a good close. People like it. So the price which comes from there is no parallel pricing mechanics, etc. So it's a robust price formation process. So people like to transact at the closing price. So we've built into the stack quite a few features to integrate TAL, but the trading at last both lit and dark. But AVD Adam is good. We like it a lot because one way to think about it, it's a 1 second or split second TAL. So it will transact everything. All that imbalance which people didn't want to contribute to the price formation, but is really opportunistic, will be able to be transacted versus like-minded folks. So that's a very good one. So as I said, it's a bit of an instant TAL. You can think about it as a reserve quantity, not participating in price formation. So for us, with the controls we already have on participating in the closing auction or in TAL across the algo stack, based on criteria which are linked to price and various price referentials, adding AVP, which is an innovative feature, and we like to support innovative features, is something we're very much looking forward to do.
Fantastic. Well, always enthusiastic to hear compliments about functionality we have coming, and glad you see it the same way we do, Thomas. So thanks.
We're not always, but
exactly. The other broker in the room, maybe your time to talk about sourcing additional liquidity, Drew. What's the Credit Suisse view on kind of sourcing liquidity, non-call phase liquidity, and how you gain access to that? What do you guys do? What's your secret sauce?
Absolutely. So we've had, as I was mentioning earlier, interest from clients for some time in how to be more opportunistic around the close. As Thomas says, it's a good close. People like to participate. People like to find liquidity around that time. We do run into some instances where we have orders that in the past we wished would trade against each other, but we didn't have a mechanism to do so, which is where something like AVD comes in, I think. In particular, if I have two institutional clients, one's a buyer, one's a seller, both are using participation constraints to ensure that they don't have excess impact. They're both trying to trade in the close. They've got large multi-day orders. Both of those clients would likely be happy to cross that stock off against one another. But in the absence of a very, very large auction, that's not going to happen because they've got those constraints on and they want to make sure that they don't push the price. So we developed a few years ago, we operate a closed cross facility. And one of the features of our facility is it allows clients to opt in to show more of their order into that facility than they would offer out into the market to participate and, in theory, impact the price. And so what we see from that, it's getting some great block liquidity at a closing auction price, but without having market impact. And I would say, AVD is very complementary to that. I think it caters to the same type of preference with an entirely different and presumably larger pool of liquidity of 6 Swiss clients who are coming into the exchange and in a similar way looking to potentially trade blocks or just cancel out an imbalance and send orders and in a slightly more opportunistic way. And as I was saying in question 2, that requires a certain amount of tolerance on the part of the client sending the order. And this is maybe where we've, in my own personal experience, run into some concerns around these types of conditional or TAL orders, where if you have a client who needs to know exactly what they're executing, say because they're doing a portfolio trade, they have some sort of market balance or beta balance, and they want to ensure that they don't get lopsided over the next day, it can be a struggle for that type of client to participate in a contingent facility. But I think as we see, especially more and more active clients get involved in sort of opportunistic close mechanisms, this kind of thing is only going to get more and more popular.
Oh, really interesting. And I like the sound of it, Drew, because it sounds like you've gone through the education process of getting clients opted in. So we hope that opt-in process is easier for us when we go live with our product as well. We know the opt-in phase is always a tricky phase to navigate with any new product. Gordon, last but not least, what is the house perception on kind of sourcing liquidity outside of the traditional call phase?
Sure. Firstly, Tom, absolutely right. We like to support innovation. We're a lot. Thank you to you guys. Thank you to the exchanges for supporting this sort of innovation, sort of drive to find solutions for problems that we probably didn't know that we had. But there we go. In terms of the TAL, yeah, that is definitely a problem. How do we automate it? I think we haven't actually found out as the buy side what exactly do we want from you guys as providers. We can't. It was a position before. We wanted everything done in a continuous. Now we want everything done in a continuous plus the auction. Now we want everything done in continuous plus auction plus TAL. And I kind of go back to what I said before about, having a trade by trade sort of active multi-day order type situation where if there is a huge imbalance in the TAL and it's bid over by several 100,000 shares, then I've probably not done my job correctly anyway by spotting that there was that big imbalance, so therefore loading up my order in the close. But then likewise, I might look at that, oh wow, it's bid over by several 100,000 shares. Well, they're still going to be there tomorrow. So do I need to hit them now? If it's only bid over in 5,000 shares, well, what's the point? I'm just signaling that there is another big seller out there. So not much point in trading. So yeah, I think there is a lot still to be done around this, and we need to decide exactly what we want, so that we can go to you guys and say, can you try and build this, or if you come to us and say we've built something that we think that you'd like, then great. We do use a closed cross strategy at the moment, which when we've used it, it's been a little bit hit and miss. You'll either get a great fill and go, oh wow, I've just executed the entire auction volume in one hit, and it's nowhere, and it's unique, it's ours. But then again, you might have one day where you sort of executed 1,000 shares and you go, oh well, what was the point in that? Well, great, it's still additional liquidity, and you were still participating in the auction independently, but yeah, it's too hit and miss to use regularly. So yeah, it's kind of every now and again, if we've got something that sort of, we'll just, okay, it's a great price, let's just have our little participation slice in there, and then we'll whack a load into the cross and see what happens. And it can be either hero or zero. So that's it, really.
Oh, thank you. Really interesting. We're hoping with AVD, hopefully by bringing lots and lots of participants to the table, we might be able to increase those kind of cross rates. That's the vision. That's the plan. I see some questions coming in on Slido. Let's see how much time we get to cover them. We have one more pre-arranged question before we do that, which is market data differences and their impact on the close. One of the major differences that persists between primary markets, closing auctions, is the market data dissemination. In other words, kind of full order book depth dissemination versus dark or almost dark call phases. SIX Swiss, our market, the LSE and Euronext offer full order book depth or fully visible closing auction call phases, whereas Xetra, Nasdaq OMX, and the other SIX market, the BME, have darker call phases with just theoretical uncross price, volume, and possibly some imbalance information that's disseminated. We see a really interesting relationship between the visibility of the primary auction and how that auction behaves. On one hand, some data shared with us by Cowen, thank you for that. We see less transparent auctions, usually see a smaller amount of price dislocation between last and the actual uncross price of the auction. But that across sort of 2021 to 2022, that size of dislocation seems to be a growing theme. However, on the contra side of that, so that kind of implies stability. But on the contra side of that, as a proportion of the exchange or of the total market's ADV, the less transparent auctions seem to attract relatively a smaller portion of liquidity. We look at Xetra as kind of a shining example of this. 2022, around 5 to 10% less as a proportion of ADV, that's unintentional slip of the tongue, was traded in the close when comparing them with SIX Swiss, with LSE, and with Euronext. When we look at our two markets, SIX Swiss Exchange and the BME Exchange, over the last, since 7 years, the BME proportion of value done in the auction has only grown 2%. And remember, they have a dark call phase. On SIX Swiss Exchange, it's grown 10% over the same period. So my question to you, and starting with you, Drew, do you interact differently with closing auctions that have different market data visibility? And do you as a house have a preference with one model over the other, knowing that there's probably drawbacks and benefits on both sides of the coin there?
Thanks, Adam. Yeah, we have a lot of different auctions to contend with, and there's even more depth of complexity than just visible and non-visible. So we do take that into account. We have, ultimately, our preferences are our clients' preferences, and that's a bit of a diverse set. I think some of the clients that we work for are quite happy with fully visible auctions, and utilize that in terms of deciding when's root orders. I think we all know, and Thomas has spoken about it, that in the closing seconds of an auction, you'll see quite a lot of activity, a lot of price movement, and a lot of new entrants coming in. So I think anyone who's in that number is very happy for the book to be open. Whether for other participants, I can imagine others where it's a bit of a frustration that if they're trying to work an order more actively, the price may not really mean much until about 5 seconds before uncross, which makes it difficult to try and take any action as a human being. So I would say from our side, do we have preference? Not explicitly. We try to work with all the different auction types. We try to facilitate our clients' needs as much as we possibly can. We certainly notice a difference. Maybe interesting to point out that this is not only the case for the auction, but also the TAL. So you've got some TALs where you have a visible book, others where it's blind, which, going back to Gordon's point, has interesting implications around if I put a large order into the TAL, am I broadcasting my entire position to the market for the next day, or do I have some degree of protection there because my order isn't visible and I'm just there to interact. Yes, so I would say we don't have an explicit preference as a house. We do try to make the best of it for our clients, whichever type of auction we're dealing with.
Oh, thank you. Really interesting. And Gordon, what is your perception on those different types of or visibilities between the different primary market closes?
Sure. Firstly, I think, Drew, your preferences are your client's preferences, but when your client can't decide what they want, it's quite hard to come up with something. In answer to the question, though, no, I don't like the German auction at all. I think it's really counterproductive by them. If you can't see what's in there, then you just don't really want to be there. So you're just going to put yourself in to a sort of POV. You may want to then sort of try and put some limits in there if you want. But again, as I was discussing before, as soon as you put limits in, you just get gamed and there's price formation around you. As soon as you go in at that price, people will just come in just in front all the time, and then you end up getting a very, very tiny percentage done. So yeah, if in the same way you want to be able to see some volume, so that as an active trader you can go, well, okay, well, if I just go up a level I can get my order done, but if I go up a level and get an extra 2,000 shares or 5,000 shares, then what's the point? I think it's crazy that we still have these sort of blind auctions. BME is slightly different because you still get the level 2 data, I think, so you can actually still see a little bit more, but it's not completely blind like Xetra. So yeah, it's not for me. I much prefer to be able to see what I'm dealing with so that I can react quickly with it and go, do you know what, I'm going to stick an extra couple of 100,000 in. Yep, great.
Love it. No sitting on the fence. Clear answer, clear preference. Market participants, you've been told. That's what we prefer. Thomas, do you share Gordon's view there? Are you a little more balanced? Do you see benefits on both sides?
Well, as a matter of fact, and personally, I share Gordon's view, but it's my position not to ask myself too many questions for things I can't shape. So in terms of auctions, we are taking the market structure we are given, right? So it's our role to work with and our job to work with everything that is thrown at us. As Drew alluded to, actually, many things, many oddities in the market. But so in terms of directly to your question, your initial question, I think the percentage of the close or the availability of liquidity in the closing auction when we did so much data search, it's correlated to the amount of the exchange volumes traded on liquid futures, right, or liquid super liquid ETF. So the ability for market makers to come at the end of the auction and provide that liquidity depends on where they can source it and where they source it on Delta One. So I wouldn't read too much into the actual percentage of the close as a sole feature of the auction data feed. I know exchanges things like that sometimes, but there are bigger things at play. That being said, there are definitely some participants which are not, and I mean more prop shops, who are most likely not going to run strategies in the blind auctions. So that could be detrimental for the overall liquidity present, whether that's something we like or not. In terms of how we interact with these auctions, but we don't interact in the same way, of course. But it does not change the availability of features to our clients. So while our algorithm consume the full order book data, so level 2 or level 3, when it doesn't have it, we can derive the elasticity of the order book from the submission of orders. So yes, Gordon, you don't see it, but the algorithm computes it fast enough to be able to react. So that's how we get by and provide exactly the same opportunistic features based on price discovery, price formation, and control of price in the closing option.
Oh, thank you. Really interesting. We are almost out of time. We have a couple of questions in front of me on Slido. There is one question that I think I can ask each of you to answer with basically 2 words. Higher, lower, or the same, and yes and no. And the question is, in 5 years' time, what proportion of on-venue market share do you think will be traded in the closing auction? Let's have this as a higher, the same, or lower. And if your prediction is right, will you be happy with that outcome? No need to justify it, just a yes, no. So maybe if we could start with you, Thomas, to kick us off. Do you think it'll be higher, lower, the same? And is that a good thing or not?
Lower, as long as the price of auction remains more expensive than alternatives. And no, it's not a good thing because, as I said earlier, we have good options in Europe.
Gordon, secondly with you.
I think the same. I think active management will come back into vogue and will be more trading in a continuous. But we're tiny.
And is it a good thing?
Active management back in vogue. What's
Easy
not to love?
Easy answer. I shouldn't have had to ask, should I? Actually, Drew, you had the longest to think about it. What's your answer?
Well, I'm going to say higher because everyone's finally going to see sense and we'll shorten the trading hours.
Condensed liquidity. There we go. And is that a good thing?
Yes, I'd love to wake up later.
Wouldn't we all? Very, very good. Thank you, all 3 of you, very, very much. Fantastic discussion, really insightful. I learned a lot, and I'm going to hand back to Andre, I think, to conclude us. Andre, are you there?
Absolutely. Thank you very much. Thank you, Adam. Thank you also the panel for this very insightful discussion. I really learned a lot, and I hope the audience did too. And yes, thank you to the audience for your time and the patience. And I hope you enjoyed this webinar and it gave you really some food for thoughts about the closing auction, about ABD. Next BörsenTalk on Mittag webinar is planned for this June. Stay tuned for more information in due time. Please also let us know how you like the panel. We would be pleased to receive your feedback. And with that, we close today's webinar. Thank you once again for your interest and time. Join us again. Thank you and have a successful trading day. Happy trading. Thank you.